Hey folks, David Frost, mystrategicforecast.com. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, November 18, 2014. You're looking at a daily chart of the SPY, and what do you know? We had another update today. What a shocker. However, there was some stuff under the covers today that we're going to talk about because this being options expiration, we look for tells. Well, we always look for tells in the market, but normally during options expiration, we look for some increased volatility in the market, which we haven't seen yesterday and we haven't seen today. However, there were some signs at the end of the day today that some other things may be developing. So I want to talk about those now. By the way, parabolic move, right? So the market does need to pull back at some point, and sooner than later is preferable. But nevertheless, when the market goes up, we just respect it, and we just go with the trend. Never fight the trend. The trend is your friend. But let's look at the 10-minute chart. Okay, this is the intraday chart, and you'll notice that at about just after 3 o'clock, okay, the market started down, and it went all the way down to the close, basically almost to the close. Just at the end of the day, it popped back up. And where did it pop back up to, or why did it pop back up? Well, this is interesting. We know that as long as we stay inside these long green candles, it's a bullish consolidation, or it's a bullish pattern until we break down or close below this candle here. Well, guess what? The low here is 205.54. We closed today at 205.55. Okay, we were lower, and right at the last couple of seconds of the day, we closed right above that number. That's not an accident, okay? It's just crazy how that stuff happens. Buy programs come in, they push the market around. Specifically, a day like today where there's light volume, they can push the market around anywhere they want. The institutions, that is. So I just thought it was interesting that at the last second of the day, they push it above this the bottom of this big green candle here. It's not an accident how that stuff happens. But nevertheless, this is telling me that there is some downside pressure under the covers of the market. And if we look at the IWM, which, as you know, is one of my favorite indicators, there's two ways to read this pattern: up move, sideways consolidation. This could be another up move tomorrow, or you could say the market was strong with the other major markets today, namely the S&P, and then we sold off today. Okay, we tried to make we tried to challenge that high, and then we sold off into the end of the day. And if you look at the S&P, which we just looked at, here we'll look at it again. Okay, and this is a 10-minute chart. All right, this was high all day. It was moving up all day, while the IWM was basically made a high in here and then moved down all day. Well, those kind of market divergences is what I always pay attention to, because they tell us what's under the covers. They normally tell us what's coming in the market, what's ahead. The market tells us what to do. And when the market tells us what to do, we have to pay attention, because that's how we make money, right? So the IWM was telling us that the market is a little bit weaker than the unsuspecting investor might realize, and that's only in the short term, right? The long term, we're still, the trend is our friend, the market's bullish. Let's go back to the daily chart. This market is bullish, obviously. It's in an uptrend. If we pull back, as the trend goes up and the moving averages go up, right now my target here on a pullback, maximum pullback, is probably about 197.50, which is right around this 50-period moving average, which is this blue line here. So if we do get a pullback, and it starts tomorrow, and why would it start tomorrow? Well, tomorrow is the release of the Fed minutes. So tomorrow would be a great excuse for a market pullback. I don't care what the Fed minutes say. It doesn't really matter, because we just look at the charts, and the charts tell us what to do. But if the Fed minutes come out and they indicate that higher interest rates are ahead next year, which is more likely than not. I mean, at some point in time, the Fed's going to want to raise interest rates. That'll be a good excuse for the media, the pundits on TV, the talking heads, to give an excuse that that's the reason the market's pulling back. So tomorrow, and by the way, Wednesday, especially during options expiration, it's also known as Wacky Wednesday or other things like that. So Whipsaw Wednesday. So the market goes up and goes down on Wednesday during options expiration. So tomorrow would be the perfect scenario for a market pullback, or even the beginning of a market pullback. Maybe we pull back for 2 or 3 days. We'll see what happens. We'll take it one day at a time. But right now, that's what the market is telling me. It's not telling me there's anything that's going to be a catastrophic decline. It's just telling us that the market is way overbought, and we probably need a pullback to consolidate a little bit. And then if we consolidate and the pattern looks right, then we can probably move higher into the end of the year for that Christmas rally. Between Thanksgiving and Christmas to New Year's, we normally get very light volume. And just like we've had over the last couple of weeks, light volume, markets tend to float higher. That's just the way it is. We never fight light volume. You don't short into light volume, and you don't fight the trend, and you don't fight the Fed, and you don't fight central banks. Okay, so those are just some tidbits that we live by, right? We don't fight things that can't be fought, right? If the Fed is printing money, you don't fight it. The Fed stopped printing money. Well, guess what? Japan's printing money. And I think the ECB is going to start printing money, like I've been telling you in previous videos. So we don't fight that stuff, but certainly a market pullback's in the cards, and we're looking for that, and we'll see what happens. And tomorrow we'll review and see if it happened. But that's what I see ahead of us over the next trading session. Let's go over to the gold market. Gold rallied early today. Okay, gold futures overnight or early this morning, we're up at 1204. Okay, and then we pulled back a little bit, and they're trading about 1196 right now. And I think we're going to make a run for this 50-period moving average right here in the GLD. And then we'll have to see what happens from there. We'll probably pull back a little bit. And if we put in the right pattern that looks like a bullish pattern, okay, then we'll look to play gold higher, because I do think it's going to go higher. I think it goes higher into next year. I think it goes higher, namely because of what Japan is doing. I think the ECB is going to join the party, and they're going to try and inflate these markets, and it's going to push gold higher. And we may or may not have put in the ultimate low in gold. I think we have. We'll have to see what happens when we start to pull back and what it looks like. But I'm pretty sure that gold has put in a bottom, and it could be a longer-term bottom. So all you gold bugs out there, you can stop listening to the talking heads that were telling you within the last week or two that there's no more reason to own gold. All the reasons we own gold in the past are gone. Gold's going to 600, 500, 800, 900, whatever they were telling you is all nonsense. They always get bearish at the bottom, and they get bullish at the top. Remember, when gold was $1,900 an ounce, $1,800 an ounce, you couldn't drive in the car 2 miles without hearing 3 commercials to buy gold. Gold was going to go up in deflation. Gold was going to go up in inflation. Gold was going to go up for any reason whatsoever. And that was the top. It's the same thing in the real estate market in 2005, 2006. Use your house as a piggy bank. Buy a house today, sell it tomorrow for a profit. That stuff's not real. Markets go to extremes, and usually the extreme high or the best move comes at the end of the move, which is normally the extreme high. And that's when all the pundits are so ridiculously naive that they buy into the story, and they get bullish right at the end when you should be getting bearish. Let's put it this way. When somebody wants something so terribly from you, whether it's a stock, whether it's gold, whether it's your house, and they're willing to pay almost anything, give it to them. Just let them have it, because normally that's the end. Now, obviously, we have a tough time finding tops all the time. We can't always pick the top, but you can see when the sentiment becomes so extreme. And speaking of sentiment, the sentiment for gold, okay, the bearish or bullish sentiment from the investor survey was 3% down when gold futures was down at 1175, 1160, 1150. That's when there was 3% of the investment advisors out there were bullish. Okay, guess what? It can't go much lower than 3%. Sure, it can go to 0, but 3% is close enough to me for a bottom. When we were at an extreme high in gold at 1900, guess what? the amount of bears out there was the same, about 3%. Guess what? Those indicators are pretty good. That's usually a sign of a top. 3% at the lows on bulls is usually a sign of a bottom. Well, guess what? It was a sign of a bottom. It's not that hard, folks. You just have to pay attention. Let's go over to oil. So I had a $74 price target for oil, okay? We hit that price target. This is the USO, but we hit that target on, what was it, over here, okay? And we bounced up off of it, and now we're coming back down. And right now, oil is trading at 74.21 in the after-hours session. And my next number for oil, crude futures, if we should break 74, is going to be 72 on the downside. If we break 72, I think 65 is in the cards, but I don't think that's going to happen right now anyway. So we'll see if 74 is defended as a low again. I have a funny feeling it won't be. I just don't like the action. You know, when gold's moving up and they're talking about inflation and Japan is inflating markets and all that, and you know, it just seems like oil should be moving up, but the whole energy complex really has been under pressure. Many of the energy stocks have been under pressure. The MLPs have been under pressure. So it's telling me that there's something unhealthy about the oil sector and the oil complex or the energy complex. So I think lower prices are ahead for oil, but I don't know that I'm going to look beyond 72 on the downside. But we'll take it one step at a time. That's my next step. We'll see if 74 gets bought, and if it doesn't get bought, then we'll look at 72. But until I see a buy signal, we're not going to do anything with it. We're just watching it right now. We're spectators, okay? Until we see a reversal pattern in oil, we don't need to buy it. Once we see the reversal pattern, we can hop on board. We don't have to catch the low because a reversal pattern should take us up for at least several weeks, if not more, and there's certainly going to be plenty of money to be made in oil stocks and also crude oil if you want to play that when the time is right. But we have to see a reversal pattern first, and we don't see that now, so we don't do anything with it. All right, I think this video's been long enough. I'm David Frost, mystrategicforecast.com. Thanks for tuning in, folks, for another episode of Common Sense Market Analysis.